welcome and thanks for joining us today. Ryan O'Shea from Garda Insurance and Jim Skinner, who's on our team. We're going to go through with you today a strategy that we call the quadruple play. There are other names for it, but really it's going to be a kind of a comprehensive dive into overfunded whole life properly and kind of how you can utilize that. So thanks everyone for joining us. And we also get to do something really fun, us in the financial industry, and show you a slide that's really boring for everybody. Feel free to call your local congressperson if you don't like the regulatory slide that Jim has to show us. It's a mouthful. So there you go. So yeah, we're going to go through a whole bunch of things as far as how you can utilize life insurance as a strategy for kind of long-term accumulation, cash flow, all sorts of things. And at the end of this, we're actually going to do an open Q&A for everyone. So if you don't do Zoom a bunch, at the bottom, there's a Q&A, I'm pointing, there's a Q&A button and you can push that and those questions will hit us and we will answer those at the end. So as we go through detailed explanations about things, if you have questions, you can write them down and ask at the end, or just feel free to put those in there. And then once we get to the end, we will answer all of your questions. So today we're doing something that shows you buying something on a child, but just realize that we can do this on almost anyone. But we wanted to show you kind of a legacy as far as something you could do on a child, a grandchild, but you could also do it on yourself as far as a saving strategy, cash flow in the future, and just a way to just kind of store your money over time. So we're going to go through specific numbers as far as an example goes. So please don't get bored on the spreadsheets, but it is necessary as far as showing you a real example is, well, what does that mean? So you're going to have some spreadsheets. Jim's going to show us some specific numbers as far as just how things work. And hey, here's what this looks like if you did it today on a child. But like I said, once again, we can do this on kind of anyone. And whether we're going to show college funding, but if you're an adult, maybe college funding is not a thing. So at the tail end of this, we're going to go through what it looks like if you don't pay for college for an individual. It just looks better. And we're going to show you summaries of kind of how all that works. But that's what we're going to focus on today. So today, pretend in this first half of the presentation that this is on your child or on you when you were a child, because then you'll be mad that you didn't do it when you were a child or your parents or whatever. But it's like, we're going to focus on a children's policy and go through kind of, hey, here's how this all works through the various phases. So the reason we call it the quadruple play is we're going to go through 4 different phases. So we've got accumulation and then college funding. I want to speak about this for a second here. So a lot of people do the 529s, and yeah, there's tax advantages on the back end on that, but there may be tax advantages that are almost identical on the life insurance. So we're going to show accumulation. Hey, we put money in, we take money out, we don't pay money back, which by the way, you could pay it back, and we can talk about that in the Q&A section because that's a whole other long question to answer. And then accumulate money over time, and it continues to accumulate, leave a legacy, but in the meantime, you actually draw down some of your cash and draw that as income for yourself. But on the back end, you're still leaving something. So it's you're not disinheriting your kids, and they're not disinheriting their kids in this scenario, since it's one of your children or your grandchildren. There will be money left in the bucket after all of this money comes out, and there's college funded, there's spending on retirement, there's still something left to leave behind. And I'm going to have Jim go through the specific numbers, but we want to go through and just kind of show you how much potential there is in kind of properly structuring some whole life insurance. And man, there's so many variables out there, but we have to pick one to show you. And hey, call us if you want us to run your scenario, but we got to pick one to kind of make all the numbers work. You know how it is. You put numbers into a computer and you needed to spit out some. We need some sort of numbers to work on, even though your numbers won't match exactly with these numbers. So, did I miss anything there, Jim, as far as just kind of what we're going to cover today and kind of the numbers you're going to go through?
Not really that I can think of.
Okay. Okay. Well, you want to hop into kind of the specifics on just the scenario that we've chosen and how many dollars are going to go in per year and for how long and just kind of how that's going to work?
Absolutely. Love to. All right. Well, first of all, I also just wanted to thank everybody for joining today. I know it's getting close to Christmas time, but thank you again for joining. Welcome. All right. So what we're talking about today is really the 4 different phases that Ryan alluded to. The first of those 4 phases is what we like to call the accumulation phase. And so many of you that are on probably have done policies in the past. And when we talk about accumulation, we're talking about funding the policy, right? The premiums paid into the policy over the years. So in this example, as Ryan said, we are using a child in this example. However, I want to let everybody know, of course, these are fully customizable, right? For anybody, pretty much anybody out there. And so in this model, what we're using is $12,000 a year in total premiums paid into the policy. And this is kind of a relatively short funding period of 15 years that we're using for this model, okay? So $12,000 a year for 15 years would equal $180,000. So we're all into this policy for $180,000 over the first 15 years. With these policy designs, of course, you can typically pay less than the $12,000. Of course, the numbers would be a little bit different. In some scenarios, you could potentially pay more if it was a good year for you. But in this model, we're just sticking to it. $12,000 a year, not a penny more, not a penny less. And you can see in this model here, we pay in $180,000 during the accumulation phase. And even by the end of this phase, you can see the second column from the right-hand side, we've accumulated over $222,000 in cash value just in those first 15 years, okay? So this is really the accumulation phase while we're paying premiums into the policy. Now, after this 15 years, we have this set up, and I'll show you here on the next slide, where we're no longer paying any premiums. We're not paying another dime into this policy for the rest of our life, okay? So let's look at that. We've done our accumulation phase. And so now, after year 15, we get a couple more years until our child, grandchild, great-grandchild, whoever you want to do this on, is going to go off to college. So in this scenario, I got highlighted here where at age 19, and you can do this, in different years, whenever they decide to go off to college, if they go off to college, we're going to draw, or we're going to borrow $25,000 a year for the next 4 years out of this policy, okay? So that's going to be a total of $100,000.
So one thing to point out, Jim, probably is
go ahead.
There are 2 ways to take money from a policy. One is a withdrawal, one is a loan against your cash value. We're showing a loan, so you're borrowing the insurance company's money, not yours, not your money, and then your money continues to accumulate. And then we're in this scenario, we're showing the loan never being repaid, but just remember that is always an option, and that'll be the second part of what we show you as well. What if there's not a loan outstanding against the policy? So it only gets better. And also I'd like to acknowledge that in today's day and age, $25,000 a year is probably not going to cover all of the college for someone, but man, it could help. It could help a lot,
Yeah. Well, that was one of the other things I was going to say too, is, if you didn't need the whole 25,000, maybe they got a grant of some kind or scholarship or something like that. These numbers, of course, could be less or more, right? It just all depends on what they need to be able to draw from the policy to complete those years of college. Mm-hmm. So thank you, Ryan, for that. So $25,000 a year in this model, we're taking that out over the course of 4 years. And in this model, throughout this entire model, I want you all to also know, we're not paying any of this back, okay? So we're borrowing from the policy in these increments. We are not paying another dime back on these loans. So these loans are just going to kind of sit out there And Ryan will get into a little bit more of the details in the second scenario when we look at that, as to whether or not, what if they don't need to go to college, or what if you pay those loans back, at least on this first piece here, where we're talking about the college tuition. Okay. So there you can see at the bottom.
And it works either way, which is what's fun. It's just it's just a choice you get to make. It's like it still works, the strategy. It's just, hey, do you want to pay it back or do you not want to pay it back? And if you do pay it back, it just looks even better.
Yeah, absolutely. You guys will see that here in a few. So $100,000 borrowed from the policy. We're not paying that back. And that's really what we're doing here for the college funding. Now, another thing to note is the tax-free benefits, right? So we're using after-tax money to fund this policy, but from there on out, as we borrow money from the policy, it is tax-free with tax-free loans, essentially, from the policy. So that's really the college funding model. Is there anything else you want to elaborate on this one, Ryan, before I move on to the next phase?
Oh, I can just hop in a little bit more on the tax situation there. So you pay tax, and typically, not always, but you typically pay tax, put money into these policies, and as long as you take the money via a loan against your cash value, this is like, if you do this properly, every dollar we show you coming out of this policy should not have a tax implication. You pay tax on the $180,000 before it goes in, but if you handle this correctly, all this money coming out, you should not have to pay any income tax on it whatsoever. Under current law, you never know how things can go that way.
That is true. All right. So the next slide, the next phase of this would be, so say we went through the accumulation phase, we funded our policy fully, we didn't pay any more in premiums in the policy from there on out after those 15 years. In this example, for the college tuition, we took $100,000 from the policy, tax-free loans. We never paid any of that back, and we still haven't paid any more in additional premiums into this policy. Now, later on down the road, we're going to have, of course, many, many years of compounding interest and dividend in this policy, right? The cash value is going to continue to grow. Cash value is represented on the second to the right column. So you guys can see, by the time this child or this person, attains retirement age or somewhere around there, right? The cash value is pretty significant compared to what we started with, what we funded this policy with, funded it with $180,000. You can see at this top line at age 65, they're sitting on about $1.5 million in cash value in this policy. Now, in this scenario, what we did is we said, well, all right, once we get to retirement age, how much can we borrow from this policy for a period of 20 years? So we want to be able to borrow from this tax-free for 20 years. How much can I borrow on an annual basis and, still have everything be great with this policy, even after those 20 years have concluded? What is this thing really going to look like for us? So in this model, we did $75,000 a year in tax-free loans from the policy. And you can see here the fourth column from the right, got that $75,000 in loans coming out every single year for those 20 years. So 65 all the way out to 84, right? And so, just to quantify that for everybody, that's $1.5 million. So we're taking $1.5 million in income from this policy during retirement, right? So now we've got $1.5 million that we're taking out for retirement. We already took $100,000 out for college, right? And as we said before, we're not paying any of these loans back. We're not even paying the interest. We're not paying any of it, right? This is just we're kind of letting this ride, and we're continuing this process throughout all these years. So third column from the left-hand side, you can see there, still only $180,000 in, right? And I've highlighted the column there, $1.6 million out of this policy in total, $1.5 million of that being retirement income from the policy.
Yeah, 1.5 million and just to explain to everyone, the 1.6 is the 100,000 in our college funding scenario plus 1.5 million in income.
Yep, absolutely. Anything else you want to point out on this slide, Ryan, before I continue?
No, I like this one, but we're going to go to the summary here in a moment. But it's kind of fun with your highlighted 1.6 million right next to the $180,000. It's like, oh, what did I get for my $180,000? That so far, and we're not even done. We're not even done on what you get.
Not even done. Okay. So now, that said, let's talk about the legacy, right? We do a lot of this. A lot of you know us for this kind of stuff, right? Whole life insurance has that death benefit that's attached to it as well. Of course, we properly fund these or overfund or whatever you want to call it. We're funding these policies to build cash value, but there's also that death benefit component, right? So that death benefit component is affected by the amount of outstanding loans we have, right? A lot of you have probably heard us talk about, whatever is outstanding in the loan at the time of your departure will be deducted from the death benefit, and your family gets the rest, hopefully tax-free. In this case, what I really wanted to pinpoint here is what I've highlighted, right? So we're $180,000 in, right? Just to kind of recap. We've taken $1.6 million, essentially in income, from the policy over the course of the lifetime of the policy. Now, say, you did all of that, you got through that 20 years of income, and at 85, you passed away. So even after drawing all of that from this policy, you can see here on that right-hand side, we still have $1.217 million in a tax-free death benefit at 85 years old that's going to be distributed to your family, or even better, a trust, right? So that's the other piece that we wanted to point out here in the fourth phase, is leaving a legacy to your family. So even though you've utilized this policy so incredibly over these years, you still have a $1.2 million death benefit that's going to be left tax-free to your state, right? Ryan, do you want to get into any other details on that before I show the summary of this?
No, actually, I think that I do want to say something on the summary. So maybe let's go to the summary so we can just point out kind of how much.
This is the good stuff, guys.
Yeah, this is the fun part. Yeah, this is the fun part. So go ahead, Jim.
Yeah, I was just going to say, so just to kind of give you guys an overview, I know we've mentioned these numbers quite a few times here going through this process, but just having it here on paper, all of it summarized for all of you. Our accumulation phase, right? We did $12,000 a year for 15 years. Never paid another dime into the policy. So we're talking $180,000. That's our input, right? Then our college funding, which in this example, $25,000 out of the policy for 4 years. So equaling $100,000 in college tuition that we've taken, right? 3, retirement income. We did 20 years of $75,000 in tax-free income from this policy. So you're keeping dollar for dollar, right? $1.5 million in total income over those 20 years. And then at 85 years old, after all of that, you still have a $1.217 million death benefit that could be left to your family. So, all things considered, when we look at, our input versus our output on this, we're netting $2.637 million out of this policy that we paid $180,000 for.
Yeah.
So
it's
Ryan, go ahead.
It sounds hokey, but it's buying someone's future, right? It's like, hey, I'm paying this amount of money, but I know what's going to happen with near certainty as far as rates of return, what I can take out of it, guarantees, all of that. And the tax-free aspect for me is, well, who knows where tax rates are going to go, but man, if you pay tax now on these dollars and they go in and you never have to pay tax again, that makes that number even bigger if you know you don't have to pay tax on any of it coming out.
Absolutely. All right. So all of that said, the next thing that we want to show you, and I'll let Ryan go through this one, is what if we don't need that $100,000 for college funding, Or there's other scenarios, right? You could be paying that loan back even if you did borrow. But let us show you the difference this makes if that doesn't happen. So, Ryan,
Yeah,
take it away on this one.
Minus the college funding, right? So we talked about these four phases. So there, and just so you know, we can always run these scenarios for you where it's like, well, what if I didn't need the money for college? What if I paid it back over 10 years rather than immediately? Any of those, but once again, we had to pick something. So in this scenario, we're just pretending that whatever your grandchild or your child got a lacrosse scholarship, whatever it is, right? So it's like, oh, well, I don't have to pay for college, or a family member covered it or whatever. It's like, okay, we're doing exactly the same thing, which would be $1,000 a month / $12,000 a year. That's where the 12,000 came from. And now, instead of borrowing and only taking 1.5 million in income over 20 years, we've actually just doubled that. So now you have $3 million coming out of a policy that you've still only paid $180,000 for. So $3 million in income. And oh, by the way, there's still a death benefit that's slightly larger. So now the numbers all just graduated on all of us. They're a lot bigger, and that was not a pun on college funding, ironically, but it sort of sounds like it. But now all the numbers are much larger than they were before. As far as income you can take, that just doubled. Your death benefit is slightly larger. Your pay into the policy is actually still exactly the same, $180,000. So now, and I think we have a summary on this one too, right? But like now your total benefit is like 4 million plus instead of 2.7-ish million. Yeah. So suddenly, without taking the loans, because those loans do accumulate interest, without doing that during the college years, suddenly now you've paid $180,000 for $4.1 million in benefit coming out of a policy, which for me, like those numbers are pretty telling. I like it, and the fact that they're predictable. So
24x based on your input.
Yep, 24x, and it's in what I would call a non-correlated asset. So it's not associated with the stock market and those sorts of things. Like it's a safe place. It's a safe bet, on kind of where to put your money. But yeah, this is just kind of a great way to kind of accumulate cash value. And people think of it as a bank account, but really it's a life insurance policy with cash value that's accessible while you're alive, not just afterward. And in our scenario, it's both. It's accessible while you're alive, and when you're not, I mean, you don't have access to it, but someone else does. So yeah. And anything else you would add to that, Jim, as far as just kind of our summaries of kind of what we were showing everyone today?
Not so much on this summary. I mean, this is awesome stuff. I mean, I love to see these kind of numbers. And just to, be honest with everybody, we weren't doing any magic. I mean, there was nothing crazy that we did that's different than anybody else could potentially do for you in this. But I just wanted to make sure that everybody does understand that we can do this for virtually anyone, right? Of course, there are some limiting factors like, age, anyone who's maybe over 75. This might be a little more difficult, may not look quite as good. Folks with health issues, things like that. Of course, those things can change the cost of insurance, which does have a little bit of an effect on these types of things. However, there are other caveats to this, right? Spouses, other family members, especially in this case, kids, that we can do these for. And again, just to remind everybody, these are fully customizable, right? So we build these policies in very special ways, very specific ways, where we work with not only your age, your health, but also your budget, right? we're tailoring these and customizing these in a way that make the most sense for you, and that you're going to have the most benefit with. So those are just a couple of things that I wanted to mention, Ryan.
Oh, yeah. And then maybe just to add to this, kind of going down the same path you are, we picked $1,000 a month, but we build these policies not just on budget, but to be flexible. So if you can afford a certain number for a certain year and then a different number a different year because times are hard or vice versa, we have to pick numbers to be static, but just realize when we build these policies for you, they're very dynamic actually, which is why you want, if it's not us, you want someone like us on your team to explain to you, yeah, you did all this. And it's like, well, your $12,000 policy might actually, a year policy might actually only have a minimum payment of $4 if it's a bad year. And it's like, well, you can make up for it or you can continue funding it. There's so much complexity, but that's why you want someone on your team that explains that, because this is very simple and very static, but we build things to be dynamic so that if times are good or times are bad, this whole strategy does not blow up in your face. That's the whole reason you build them, to be dynamic. And then obviously all the other benefits we just went through, all the cash, that's the sexy part, is all the cash. That's the fun part.
Absolutely. All right.
So, oh, look, there's our team. Yeah, thank you, everybody. Just wanted to throw up some kind of contact information in case you want to call or find us. And then as soon as we get through this, we'll go into Q&A. We also have future webinars, and we'll go into that as well.
Excellent. All right. Well, if you need to take this snapshot, great. Most of you know us, right? So you can reach out to us directly. You're welcome to call this phone number, 801-658-7138, to talk to our assistant and schedule a time for us to talk if you want to talk in more detail. Ryan, do you want to talk about next month?
Yeah, for sure. So we I don't know if partner is the right word, but Court Pitcher is an owner of a company called Legacy Lock. So obviously, when we're talking about leaving a legacy and leaving things behind, so it's, yes, spend the money while you're alive, but also leave something behind. A lot of people struggle with, well, hey, I don't have my wills in place, I don't have my trust in place, or they're old or outdated. We have a resource for that, not just in a, hey, I can do the mechanical part of things, but like, should I do it like this or like that, and why? So our next upcoming webinar that we have in January, it'll be myself and Court Pitcher going through kind of, part of it will be the legal side, and then part of it will also be kind of the policies themselves on how we're going to be able to utilize them while we're alive, plus then when we're not alive, what does that look like for the rest of my family, friends, charities, whatever everyone has a different goal, and it could be all of the above. So he's going to join us and talk us through kind of, first of all, how to do all that, but he's also, his company's also a resource to actually help us and help you get it all done.
Awesome.
Anything else there, Jim?
You guys should be
question.